Welcome back to Wash Talk, the Carwash Podcast. I'm your host, Rich DiPaolo, and joining me today, we welcome back in Jeff Pavone, founding partner, and Chris Jenks, partner and CEO of Amplify Capital Group. So great to see you, gentlemen, today.
Thank you, Rich. Likewise.
Yeah, it was good to see you guys in the at the Car Wash show in Las Vegas a couple of months ago. I wanted to bring you both back on the program to discuss something, maybe many operators are questioning today, and that is it the right time to sell a car wash business? But just talking about that car wash show that we attended in Las Vegas, you both put on a great presentation at the Spark Theater, which I was grateful enough to be in the audience. It was standing room only by the time I showed up, so I was unfortunately one of the people that was standing in the back, but no shortage of attendees to that great presentation. You both presented so much great information at the show. So for those who couldn't attend or view the Spark Theater presentation at the Car Wash Show 2025, what were the key highlights and takeaways? And what has been your reaction from the market after presenting all this great information?
Yeah, I'll go ahead and take that one, Rich. And thanks for your comments. I was very pleased with the attendance. I think just the overall setup of the Spark Theater was really well done by the ICA. It's a little bit more of an intimate setting, right in the middle of the trade floor. But the spirit of the presentation was really intended to be more or less an open and honest dialogue around some of the recent challenges in the car wash sector, right? I think to no surprise any of the listeners here, it's been a very remarkable and dynamic stretch for the car wash sector over the last 5 years or so. We've witnessed increased consolidation fueled by heightened interest from the private equity community. We've had booming innovation and technological advancements, as well as some just remarkable growth by way of continued consumer adaptation and unit expansion. And while there's been this overwhelming wave of euphoria and optimism in this space, no surprise, we've had a couple of black eyes recently. With the likes of Zips filing Chapter 11, we had Driven Brands divesting their Take 5 car wash portfolio. And this is a fairly opaque industry. So what we want to do is provide some clarity as to what were some of those drivers of stress and more or less be a cautionary tale for what matters most in this business, which is operational excellence. And despite some of these recent challenges and hiccups, deals are still getting done. There's still excitement around the car wash industry. And the reason for that is that the long-term thesis remains well intact. Right, you have consumers that continue to embrace the express car wash model, professional car washing as a services, and the fundamentals of a well-run car wash business are still incredible. Right, there are very few industries that offer some of those high-level fundamental characteristics of 2 million plus in average unit volume, with 75% composition of recurring revenues with the unlimited subscription base, highly scalable. But again, it's all about operational excellence. And as we think about some of the value creation levers in this space, you of course have value that could be created through just the arbitrage of the transaction, and you have value be created through operations. And unfortunately, some groups focus more on the former, which was around kind of over-levered expansion and some really irresponsible capital allocation decisions centered around the use of real estate. But again, the overarching message is that this is still a great business. Deals are still getting done. There's still enthusiasm around this space, but the focus is less today about unit level expansion for the sake of expansion and more about building a portfolio of high quality, well-performing assets.
Yeah, I often say it internally to my team. And in a lot of ways, we've seen so much change and technology and advancements in this industry, but in many ways, it's back to the basics. What makes the customer happy? The importance of having that clean, updated facility, not letting anything kind of get sad looking or run down or tired looking. It's really making everything look great and fresh. And there's a lot of reasons for that. And I'm glad you guys tapped into that in your presentation.
Definitely. Just to expand that, Rich, anecdotally, we're hearing from the vendor networks that same kind of trend, right? In that the focus is less about equipment orders for de novo or new units and more about the reloads and getting facilities back up to standard. And I think, I personally think overall for the long-term healthy industry, it was a very healthy reset in terms of reprioritizing what matters most, right? Dry, shiny, clean car with fantastic customer experience, great real estate, back to the basics and back to the fundamentals, which drove that initial stage of interest around this industry.
Good, Jeff.
Yeah, what I was going to add to this is, what's keeping the buyers coming back is that the car washes are performing. So when you look at the numbers and you look at the members and stickiness of the member and the volume of the car washes, they're performing quite well. And so buyer interest is come look and took a hard look at it over the last couple of years. I've taken a very deep dive looking at the numbers and saying this is a good business. This is one we want to be in. And it's proven to be that the customer is proving that this is a good value. They like this business. Car washes are performing. So we're now seeing buyers come back and quite frankly, much bigger buyers coming in this space saying, this is a long-term business we like.
I mean, so many people get excited when they talk about their visit to the car wash. It's no longer just that mundane task. People actually look forward to going to the car wash. People have told me it's their moment of zen, and they're really, really happy with their car wash experience these days, which is great. And just to close the loop on that presentation, I believe ICA offers it on demand after the show for a certain period of time. But anyone who's interested, folks can reach out to Amplify Capital Group and maybe get that presentation or hear that presentation from you guys. Is that an option?
Yes, absolutely. So we do have a video link that we'd be more than happy to share. So I will say in terms of the reaction to the research, I think, the feedback we've received is some really valuable data points that aren't widely available or shared. So we do have some slides in that presentation. We do have it available. So any information, whether you're able to participate in that presentation and you want the follow-up or you weren't able to attend, please feel free to reach out. Be more than happy to get you that content.
All right, cool. I learned a lot. So I encourage everyone out there to get their hands on that presentation as well. But we often talk about buyers and sellers in this market, Jeff and Chris, and certainly I want to get the state of sellers and where their heads at nowadays. But let's first talk about the buyers. Can you walk us through the current state of buyers in the professional car washing market today? Who is active and what kind of deals are they looking for?
Yeah, I would say we've got buyers looking for a few things, right? The buying community is looking. One is to buy smaller deals, 1, 2, and 3. Let's say if it's in a market, everybody's looking to straighten up the markets that they're in. So if they got 8 or 9 locations in a market, they'd love to add on 2 or 3 more. Now, so I'd say that's one type of deal getting done. It's just fortifying the regions that they're in, realizing that they need to be if you're gonna win in the car wash space long term, you need to be in a dominant position in the markets you're in. So they're definitely focused on that, and they're divesting of stuff that they look at and go, we added this on when we acquired, let's say, a chain, but we'll never be a dominant player and we can't build a brand. So they're divesting of those sites. The other thing that's happening is bigger regional players now become very favorable. So if somebody is a market leader in a part of the country, it can be very desirable for a platform that wants to grow their own platform. They're really highly focused on buying the market leader, and those are getting a premium. And so we've got several of those deals now that we're involved in. But the buyers are, again, they're disciplined, but they're motivated, very, very more motivated now than I've seen them in the last 2 or 3 years to going on and getting deals done. So that's what's exciting for us to see.
Just to add to that, I think one thing that's interesting is, there have been a number of buyers that through that early stage of consolidation, let's call it that 2020 through 2022 timeframe, they believed in the thesis in the car wash sector, but they just couldn't, get into the space by paying a mid to high teens multiple. So they sat on the sidelines more or less. Those groups are still very much interested in this space, and they see now, today presenting a better entry point into the market here. So it's interesting. A lot of the big blue chip top 10 names that didn't fully get in this space, they're still highly interested in poking around, looking for good accretive acquisition opportunities to start a platform.
Yeah, I mean, real quick, just adding that where Chris is going, the buyers, if you look at the top 25 guys, it changed a little bit. What I would say is the buyers that were disciplined in growing their platform are growing because they like what they have. So let's say they've got 100 locations and they want to continue to grow. The guys that were disciplined and have quality assets and they they paid a fair number, they're looking to grow. They like what they have. I would tell you the buyers that are on hold or kind of stuck in the mud are the guys that came in guns a blazing and paid up on these multiples to catch up to everybody else. Those guys tend to be sitting at a bad spot because they've got to work their way down on operations before they can even begin to get a sponsor to put more money behind them and grow. But the guys that were disciplined and prudent about how they grew their business, they like what they have and they're going to keep growing. And like Chris said, a lot of the buyers that were on the sideline to look at this is too frothy of a market to get into now want to enter.
So Jeff, you and I, many years ago when this M&A activity started to ramp up in the late 2010s, it seemed that quantity was an important factor over quality of sites, right? These guys were rushing to buy larger portfolios. You and I had talked about those middle tier, 25 to 50 ranked locations on our top 50, selling these mid-sized portfolios to these larger companies. So how has that changed? Has that changed at all? How interested are buyers today in acquiring smaller portfolios, let's say 1 to 3 locations? Does size still matter in today's market on the buyer side, or is quality of sites now more important than quantity?
Yeah, I mean, I think the thing that got the car wash industry in trouble a little bit was get big fast mentality. I come out of the internet days when that happened, and it didn't end well for the guys that just scaled for the sake of scaling. So the car wash changed its scale to get size of quantity and didn't really care about how we're going to integrate culture, how we're going to, how do these units look and how do they feel? What kind of brand consistency can we have? They're getting punished. The bad behavior that happened in the space are getting punished, and the good behavior is not. And so it's all about quality. I think people are looking at their brand and saying, does this acquisition fit our brand image? This is what we want to look and feel like at one of our car washes. The other thing, it's got to meet certain metrics about, does that volume worthy of it? So you've got to manage these sites. So before, when the buyers were buying, they bought it sort of just based on a quantity thing. Today they're looking at it, we got to run these things. So we've got to put a regional in charge. So do these sites have enough volume to warrant us putting the energy to go drive volume? And if they don't, they're not buying them. So yeah, you're spot on. I think is the shift today is about quality, meeting certain KPIs. But the buyer today, the advantage the buyer has today is they have a lot of data. They're much smarter. They're educated, and they know exactly what works and what doesn't work. So I think that's the market we're in today, which is good for everybody.
I do think you want to double click on a word that Jeff mentioned here, which is that very important I word, integration. Right. I think that was a big lesson learned of the first wave of consolidation in this space is integrating these acquisitions. It's not easy. I think a lot of these groups do have a certain level of integration fatigue, which makes kind of these bolt-on, more strategic infill acquisitions a lot more viable in today's market. That said, going back though to some of the sponsors that didn't participate in consolidation a couple of years back, I think they're still looking for deals that are of size, right? A really nice entry point to come in where you could buy a platform of multiple units with a good leadership team and structure in place to go build around. So I think it really depends on the profile of the buyer, but generally speaking, for those groups that have already deployed capital in this space, the smaller infill, more fortification acquisition strategy, again, coupled with just the strategic viability, but also just integration's easier. And I think that was a big takeaway from the last couple of years.
Jeff, something else we haven't seen in the past that we're seeing now, and you and I were discussing it briefly just before I hit record here on this interview, is now that some of the traditional buyers in the past are now becoming sellers. How is that changing the buyer-seller market when you have a company that has 200 plus locations now selling off a few locations?
I think what it's done is it's basically put some inventory on the market, but I tell you, the majority of the buyers are guys that like, say, Club Car Wash. Club's bought quite a bit of it, right? They basically can look and say, does it fit their footprint? And if it fits their footprint, they've got operating and development teams ready to go. So, I don't think it's going to change much because there's, like with Zips, I think they're selling a few units, not a lot of units. They're basically decided they brought in Pete Nana as the CEO, good friend, and Pete's going to take charge of that company and go try to improve operations and stabilize that company. I just think they're also going to be select buyers. Pete told me this week himself that they're going to be looking for acquisitions that fit their footprint, which is a good thing. On the Take 5 with Whistle, I think Whistle is going to look at their own company and say, what sites that we acquire fit our overall strategy and which ones don't. And they're going to sell off the ones that don't fit their long-term strategy, and they're going to keep the balance of them. So I don't see a whole lot of change. I think we'll see this year kind of just a little bit of cleaning out of what past mistakes have happened. And once that gets cleared out, you'll see, it's full speed ahead.
Yeah, well, one elaborate. I definitely think the Zips news and the preconceived thought about Zips being a fire sale is definitely a false narrative, right? Chapter 11 is something that happens more often. I think a lot of people realize. I believe last year there were over 3,000 Chapter 11 filings. It's merely an effort just to restructure the cap table, to put them back in a position for growth. And everything we're hearing from the Zips leadership team, as well as their capital partners, is that they're very much motivated to grow that platform. So I think what you're seeing there is not a fire sale or a widespread divestiture of assets. It's just more of a rationalization of portfolio to tighten up some of their geographies that they're currently in. Rich, to expand on kind of your comments of expecting the top 25 board to shift quite a bit, something we've already seen and will continue to see. I think the one thing we talked about a lot at the show in terms of predictions is more consolidation amongst that top 25 cohort. If you're to look at some of the earlier entrants into the car wash sector, whether it be Access and Spotless, Red Dog with Mammoth, Imperial with Go Car Wash, they're kind of in those later stages of the typical hold period for private equity. I think that the viable exit strategy for them isn't the path to public markets, but there may be some mergers and acquisitions amongst names in that top 25, which is definitely going to reshape the unit counts.
Yeah, and you got some, groups like Quick Quack and Club, I think, are probably the most, tidal wave to some degree. I mean, are growing at a faster clip than a lot of the other groups because they've got an M&A strategy, they've got a development strategy, and they can work side by side and keep growing. Mister's kind of got their hands tied a little bit because they're publicly traded, and they can only acquire stuff based on what their stock price is looking like. So they're kind of a little bit as a disadvantage of some of the private groups. The private groups look at this stuff and they say, we see a lot of value here. We can pay a little bit more. Mister's got their hands tied a bit on the M&A side, and as we're seeing that the greenfield strategy takes a long time to get sites bought, built, up and running. Without having an M&A strategy to go along with a greenfield, you're going to see some of these the private groups fall a little bit behind the private groups fall ahead of the public groups because they just can grow quicker.
Interesting. Yeah. And some of those company names that you mentioned, just Tidal Wave, Quick Quack, I've interviewed some of those companies that you mentioned in the past. And what stands out to me is they have, strong operators. So they've had at the head of those companies, strong operators that have been in the market for decades that know how to run these car wash businesses. So when you team that with big funding, it's no wonder why they're finding success today. And in my mind, anyhow, but we often talk about some headwinds, right? So tariffs, federal interest rates, policy changes, financing challenges. Are these slowing momentum at all? What are the big headwinds facing buyers today?
I'll take a quick first stab at that, Jeff, and want to jump in. I think, you hit a lot of it in the head, right? Anytime you have these headwinds in capital markets, it makes underwriting a deal a lot more difficult. And this isn't specific to car washing. This is pervasive across M&A. We've seen M&A largely slow in the first half of 2025 for that reason. So I think some of the headwinds for buyers today, you hit on one of them, cost of capital is still very high. 2022 through mid-2023, we saw the Fed go from 25 basis points to 5.5% like this. And even while the Fed has cut modestly here, we're still hovering at about 4.5%, which is elevated from the last 20 years, let's call it. So cost of capital is still one real headwind for the sponsor community to really fuel M&A. You also have a little bit of a gap between seller expectations and buyer valuations, right? I think that's a big headwind in deal making here in the car wash sector. Cost of capital and valuation multiples are inversely related. That's just the reality, right? Cost of capital goes up, valuation multiples compress. And, one thing we've been saying a lot is that there's this narrative that multiples have cratered in the car wash sector. The reality is where we were in 2022 is more the exception to the norm, and where we're at today is, I think, healthy levels as it relates to valuation multiples for both buyer and sellers. But nonetheless, where you have a seller pool that's still tethered based on where 2022 multiples were and where 2025 multiples are today, there's still a fairly wide spread between the bid and ask there. Then you also have the macro uncertainty here, right? Where we have a lot of geopolitical considerations across, globally, not unique to the U.S. Something that could be a headwind today, though, that turns into a tailwind, though, is policy change, right? As we talk about Trump-era tax policy and restoring bonus depreciation, that could be a big boost for buyers and sellers alike, but specifically for buyers where you have these uncertainties in your underwriting model. Given the capital intensity of the car wash sector, that is one big tailwind. So as we talk about the geopolitical land front, while there's uncertainty, it could turn into a positive here in the long run for buyers. Financing structures and pressure over leverage, I think underwriting standards across the board have gotten a lot more challenging. We're not seeing a lot of credit being given towards run rate EBITDA or pro formas. So finding track records to really wrap capital around is critically important, which makes buying a little bit more challenging. And then, of course, as we talk about the sector as a whole, we do have a lot of newer units that have hit the market here in terms of greenfield expansion over the last 3 to 5 years. How do you give full credit, or how do you put a valuation on a ramping unit that is not quite yet at maturity where you could trade at a multiple of EBITDA? And how does that translate to actually getting a deal done with a seller that's expecting full value? That does create a little bit of conflict in the deal structuring.
Chris, maybe to elaborate a little on that, because I think that's one of the big things, is the cost of building a car wash today has gone from maybe $3 million when this thing started to $7-8 million, right? And you look at it, and then there's more competition out there. So the ramp profile is different. Before you'd open a wash up and you're ramping up almost immediately. Today it could take a couple of years to get to a number to break even. So that cost of that, and so when you look at a buyer that's more disciplined in buying cash flow, and you got a seller who's got a lot of more costs and a longer time to ramp up. It's that timing piece of it. That's why, we are so, as a firm, we're so committed to helping the car wash community understand that you've got to be on your A game on operations. You got to be driving. You got to drive memberships. You got to. There's no more, open it and they will come kind of mentality. So we see one of the biggest headwinds right now is that the cost to build these things. And then a buyer come in who's paying this elevated cost of capital. Let's say their cost of capital is 10%, and you got let's say between your cost to build and your burn, you're in it for $8 million. There's a little bit of a juggle here how to make that math work for buyer and seller.
Yeah, I think that's interesting with a couple of things on, inflation driving higher build costs. You also have human output, just labor output in general, that hasn't fully recovered since COVID. So to get a new unit online, before you could potentially put a new box online in 9 months, that's bleeding longer and longer. Then you couple that with challenges with municipalities and permits. With multiples compressing to where they are today, the incentives behind greenfield and M&A are totally different. You could pay slightly higher by way of acquisition, but you're not able to expedite your cash flows, right? You're not sitting 24 to 36 months until you get this thing stable. That was one of the big interesting takeaways. I think the learning lessons here, a lot of these pro formas were built based on what was experienced in 2020 and 2021. But the reality is you had a lot of discretionary dollars flowing through the system. Consumers had nothing but time and money in their pocket. That's different today, right? So it's not one of those things where you build a box, flip the switch. The ramp profile is very real, which I think it's one thing that's super important today. If you're an operator looking to sell, is having some proof statements and a track record to point to in order to get more credit on your de novos that may not necessarily be fully mature or ramped.
So maybe just wrapping up with some positive news, a tailwind, right? And that the pricing car wash costs, right? People have charged, retail costs of a car wash have gone up significantly. Yeah. I mean, it used to be $3 not that long ago. And now we're seeing guys go to $10, $12 for the bottom wash. And so when you look at the average, cost per car that we're getting, we're not finding customer resistance like we thought. The customers look at this and say, this is still a value. They're looking at what if I got to pay $30 or $35 for a membership, this is still a good value. So that's been really positive. So we're seeing positive growth on top line, positive growth on bottom line. So that's helping even out some of the costs that we're seeing. But I would say that's a real positive trend, and I think most operators are seeing that.
All right, thanks for ending us with a tailwind that is obviously very great news for the industry as a whole. But so we're about 25 or so minutes, give or take a few minutes here into this interview, and I've yet to ask about sellers. So I'd like to shift our focus specifically to sellers with these next few questions. So from a seller's perspective, what factors should they consider maybe before taking their washes to market?
So, of course, I'll jump on this one. I mean, I've been having a lot of dialogue with sellers, more probably recently in the last, call it 30 days, than I have in a couple of years. And I think a lot of sellers are sitting here saying, I'm on the fence, and I'm on the fence, but I'm leaning towards just selling now. And I think that everybody's got different situations. I think one is you got to look at your age and where you're at in the cycle. Are you building this company for forever? I know there's a lot of families out there, the crew car washes of the world, that will continue to run this thing forever, and they're doing a great job. But there's a lot of operators that built this as a business to eventually exit out of, and they're saying, okay, when should I go? And at some point you got to look at the cost of your capital costs that you got tied up. You got to look at your personal guarantees. You got to look at your own life cycle and say, where am I at in this thing? I think the harsh reality, multiples are not going to get much better. The multiples we have today are multiples that are probably going to be there tomorrow. I think Chris is spot on. At the end of the day, this is norm. What we had before was just exuberant in the marketplace that drove up multiples. Those days are going to they'll never be here again. So this is definitely the norm. So a lot of sellers, I think, are leaning in now. We've gotten some really high quality deals going out to market that we wouldn't have had a year ago, because I think sellers are saying, assuming buyers are interested at this current multiples, we're an interested seller, because they're just looking at the time to fully maximize the value of your chain, maybe longer than some people want to wait.
Yeah, just to add a little bit more prescriptive advice. I mean, if you are a seller looking, entertaining selling at the moment, I think, financial readiness is critically important, right? Having clean financials, ensuring your books are accurate, consistent, professionally presented, but also understanding where you may have opportunities to normalize your EBITDA. So understanding, true earnings, right? Are there any one-time expenses, owner compensation, personal expenses, anything that can be an add back to help boost your cash flows, of course, going to drive value. And then really understanding your revenue mix, right? The more you can demonstrate that you have higher membership penetration to show greater stability in revenues could command a premium there. Also, I mean, one thing that a lot of groups or a lot of sellers don't fully appreciate until it's too late is, tax planning. Something we don't do at Amplify, but there are plenty of professionals out there, but just making sure that you have a good understanding of your personal strategic timing and making sure that you're prepared for an exit. Very important, what the goals are with your wealth that you're about to create. Other things to consider, here's real estate. I think this is something that's been really interesting the last 2 years. Before, the real estate was such an important piece of an acquisition, just given distortions in the sale leaseback markets. Today, you're seeing a lot of creative deal structurings with sellers holding their real estate and essentially selling OpCo and turning the real estate into longer term mailbox money, which could also have some tax benefit to it as well. So thinking about how you view the real estate as a part of a transaction, more importantly, what it means for your family legacy and wealth longer term is important. Then going back to a lot of Jeff's comments, operational maturity, definitely important, just given, again, where ramping units are today and how buyers are bailing ramping units. Also looking inside the tunnel, I'd say one of the big lessons learned and something we've talked about before is maintenance and quality of the equipment and not deferring your maintenance, making sure you have a tunnel that's up to standard, that's fully operational, because that is definitely something you're starting to see being adjusted from a buyer lens, is that they're now understanding how much CapEx is needed to get this facility back up to standard. So making sure you have good, clean facilities, good real estate, strong financials and professionally managed financials, and then also reflecting personally to understand what the end goal is.
Just wrap a big bow on this question. The big question is now a good time to sell a car wash business. It sounds like there's no real reason to wait. It's as good as it gets now, right?
I got to tell you, at least in my, we're getting this question asked every day, and as we contemplate this and say, okay, it's now the time to sell. I would tell you, I don't see multiples changing much. I think we've got to look at on a deal by deal basis. So every operation's got to have much more analysis put behind it. Before, our job was easy. We took it out the market, somebody bought it. Today, we're putting a lot more thought behind it. So whether, let's say it's taking today, it may be a 6-month, maybe a 9-month, maybe a year-long process to say, how do we get the maximum value out of it? And we can do it through adjusting what you're paying for chemicals. Right. There may be 2 or 3 things that you're doing that could add significant bottom line, which will get you more top line. So, but I'd say today you've got a willing and able buyer looking for quality opportunities. So you don't take that for granted, because it could be a year from now and the world can change overnight, and the music stops and they stop buying. So you got to ask yourself, what's more important to you? And individually, you got to answer that question. And so it's more important to me taking and having a deal done now, a quality deal, and taking some of my cash off the table, or could you take the risk of waiting, knowing that the music could stop, the bars could go away, and you're going to have this car wash chain, you're going to run it for the next 3 or 4 or 5 years, because there's no guarantee that the buying community will be there next year, because the way the world's working, when you look at the world, I got to tell you, anything can change the financial markets and quickly. And so I would say, if depending where you're at, but if you're looking to de-risk, there's right now there's good buyers and good opportunities out there. But just, I would say, get a good advisor, know exactly what you have, what you're selling. There's a lot of structure to deals today that could be very favorable to a buyer, or could be very negative very favorable to a seller, or very negative to a seller. You've got to really know how to get these things structured. More importantly now than ever, as Chris mentioned earlier, what is the tax consequences going to look like? How do you get paid for ramping sites? All this, everything's negotiable, by the way, Rich. Everything out there is negotiable. So the question is, do you have the knowledge to be able to negotiate a quality deal? I would say, if you've got the right advisor, you probably are. If you're trying to do it on your own, you may not know everything that they're going to throw at you. So, but individually, I think it's a good time to sell if you're looking at it in the next 2 or 3 years, because I just don't know where the world brings a year from now.
Have you run into that, Jeff? I know you've advised a lot of sellers and been at the table of some of these M&A activities. Have you run into that where a seller felt like, maybe if I wait a little bit longer, I can get a little bit higher multiple, and then the opportunity passed that seller by, where the buyer was no longer interested in the business, or they actually got paid less maybe?
We can do a full podcast on the guys that woulda, coulda, should you of taking that deal they had, and they thought they were going to wait another year, and you got to look at it. You're working too, right? So they worked another year to now have to sell for less money. And again, let's say you have and then you got Place for AI, you got all this technology. Anybody, you got a great site. It's washing 300,000 cars. You're making lots of money. You're on top of the world. Somebody, all of a sudden, one of the car wash companies, laser technology on top of your washing and saying, wow, these guys are washing a lot of cars. They don't have to ask you. They don't even need your numbers. Next thing you know, they're buying a piece of real estate building down the street from you, and you just lost, 500,000 of EBITDA, cost you $5 million. It's happening, over and over again. So anybody, with some I've seen it. So we can do a whole podcast and case study of guys that said, I waited a little too long. I was too greedy.
We'll have to figure out how to do that without mentioning any names or company names to protect the innocent, right? So, the last question here now, and I certainly appreciate you both taking some time to discuss all this with me today. But what are the most important value drivers for buyers right now? What can sellers do to maximize the multiples and valuations today?
I think Chris and I will both take this one. We'll jump on it, but there's, I'll start with the basics, right? It's really understanding, knowing your business. And when I mean it, there's like, and I'll let Chris dive in, there's the operational component, there's the real estate component, there's your market strategy and fit. And then it's understanding who you become more of, who the buyer, what buyer would benefit most by having you. And so there's, and all of this is like when I tell you our job became 10 times more difficult, like we look at 100 things, Rich, to help determine someone's value or to help to improve their value. So we have one chain now we've taken out to market a year ago, and then we pulled it back because we knew we had to do 3 or 4 things to get the ship righted. And I can tell you, we're going to end up getting them a deal done, hopefully in the next 30 days here. We'll get them 20% more for that same chain by waiting a year. You got to know how to deal with like a lot. Weather is impacting chains across the country. How do you answer that question? There's a normalization. Some buyers will buy into it, some won't. So there's I would tell you there's 100. We've got 100 things in our checklist that we're going to work on. But it does come down to, understanding your real estate, understanding your pipeline, understanding your competitors, understanding your own pricing matrix compared. Like there's a lot of things that we're doing to build value and when we're going to take something to market. Chris, I'll let you jump in on this as well.
No, I think you hit a lot of it already, Jeff. I mean, going back to one thing we already talked about, can't overemphasize the importance of having just professionalized financials in maximizing value. I mean, and not just that, but understanding areas for normalization. Again, that's critically important. Operational excellence, definitely something that drives value. Want to be able to demonstrate the ability to maintain equipment, have clear SOPs and training protocols, operational manuals, et cetera. Investing in areas of your business such as site cleanliness and maintaining facilities, all really important. Maximizing recurring revenue, right? The greater stability you have in recurring revenue typically results in a premium multiple, right? There's a direct relationship with having lower risk in the business by having a greater recurring revenue base. So having a clear strategy of driving membership penetration is important. The real estate position, and making sure, you have a clear and articulate strategy around the real estate acquisition and demonstrating dominant position in your real estate. And you also want to show a path for growth levers, right? Everybody's looking for how could I grow this cash flow at the early entrance. And I think, Jeff highlighted a couple of precedent deals or case studies that we're working on now. In order to really maximize value, you need to show the buyer what levers they could pull to grow. So it'd be, continue maturation of ramping units, pricing strategy, lowering your cost of goods by, securing better vendor contracts around things like your chemistry, highlighting untapped potential, whether it be digital marketing strategy, fleet plans, direct business to business sales, or a pipeline of new sites. You need to be able to demonstrate some level of growth in the process to uncover some value. And then the team. I mean, I think that showing a deep bench of team and a really well thought out organizational structure is important. And let us do our job, right? Finding the right advisor is very, very key today. Jeff mentioned that a lot of these deals today do have a lot of structure. It's very hard to find a clean deal. And sometimes structure could be to your advantage, sometimes could be to your disadvantage. So making sure you have the right advisor by your side to navigate kind of some of the creative deal structures in today's environment, that's probably the most evident way to maximize value.
Yeah, I think Chris, as we meet with chains every day here, we're looking at it, and it's everything from their team, how they're trained. So when I'm a buyer, I'm looking at coming into your market and buying your company, and I'm looking at all the things either I got to fix, are the things that you got right that you can add to our culture and our company? So when I tell you the really great news is really great car wash companies are getting rewarded, getting paid very well for the value they've created. And so there's a huge advantage to investing into your company, because you're going to get paid for it. They ideally buyers want to come in and put gas on you and grow and put fire and make you grow. If they got to come in and start fixing you, I can tell you, you're not going to get the premium multiple or outcome that the next guy is that has a quality company.
Yeah, I think that's so critically important, Jeff. I mean, culture. You could spend $500,000 in acquisition and fix a tunnel. It's very hard to stroke a check to fix organizational culture, right? That's the DNA that comes along with the acquisition. What is the DNA of the organization? It's one of those things that any buyer can't spend a dollar amount and immediately fix it. So making sure they have that strong organizational culture, the DNA that lasts, that's a big one.
And maybe I just want to say one thing to be really clear about the cash available. The buyers have cash. I mean, if the opportunities are right, is a good quality deal. I don't care if it's $25 million or $250 million. The buying community today has the credit markets have freed up, and they've got cash to go buy a high quality premium chain. That's when you say what's different today from what was different from a year ago, 2 years ago, that credit market's open up, and there's plenty of cash available to buy.
Well, that's great news. It sounds like if you're a seller, get your stuff together before you head out to market. And and just before we leave here, I'll ask the question. We saw 2025 open up with some big pieces of huge news in quarter one. What are your predictions for quarter 3 and 4? Are we going to end the year as we started it with a bang, or is it going to be quieter? Do you predict?
Jeff, can I go with that one first?
Yeah, I mean, I would tell you first off, the first half has been quiet. I mean, the fourth quarter was a really good quarter for the space. I mean, we closed $300 million in the fourth quarter alone, just our team on several big deals. The Trump tariffs and the political things going on took people by surprise. They couldn't figure out where we're going with build cost, steel, and a lot of things got in the way and driving the first half down a bit. Right now, currently, there are some major deals being worked on for the second half of the year. So we're anticipating a very, very, very robust, strong, probably the biggest finish of a year in 3 years coming in this last quarter of the year. So we're expecting great things to happen here. But Chris, you want to add to that?
Yeah, no, I definitely think so. I do fully expect that we'll get more clarity in the macroeconomic front. Think, what we're looking at here in terms of Fed rate path in the second half of the year, could probably expect a couple of cuts, hopefully have some certainty on the tariff front. But I think the biggest driving force behind an acceleration in deal flow is just the fact that there's so much dry powder in the sidelines still.
Yeah.
You have private equity sponsors that are late in their holding period in the car wash sector already. You have the need for capital recycling, right? That the sponsor community is going to be in a position where transactions are going to be absolutely necessary. So I do think when you take some of these outside forces coupled with what should hopefully be a better macro environment, you should see a really big uptick to close out the year here.
Well, it's certainly an evolving market and an evolving M&A picture. And Amplify has never been shy to come on Wash Talk. I definitely appreciate you taking all these invites that we give you to join us on the program and help our audience understand some of these dynamics that are going on in the market. So thank you very much, Jeff and Chris, for joining me today.
Thank you, Rich, for having us.
Always a pleasure, Rich. Thank you.